Hey, welcome back to The Dive. Battery metals, Russian gas, the yield curve inverting, the 10-year yield, and consumer confidence expectation versus the present situation are some of the topics that our guest will deep dive into today. He is a partner and portfolio manager at Crescat Capital. Tavi Costa is joining us today. But before we bring you Tavi's interview, do me one quick favor and go ahead and just tap that subscribe button, please. Hey, Tavi, welcome back to The Dive.
Thanks for having me again.
Yeah, thank you so much for joining us. Okay, so Tesla inked a multi-year supply deal with mining giant Vale long before both the Russia-Ukraine war started and the nickel short squeeze. Do you think that Tesla is ahead of its peers in securing crucial battery metals? How close are you following the nickel market?
I've been following the nickel market very closely. I don't know the answer for Tesla, and it's the battery metal technology may shift over the years, and who knows what's going to be the right metal to be invested in. But it's certainly the case where we're seeing now nickel projects in exploration space that are looking extremely attractive. It was difficult to justify the investment given the fact of the price or how economically difficult was to extract the minerals from nickel deposits. And I think with nickel prices where they are, it's starting to become more economical and interesting as an investment. I've been following when it comes to the issues of the clearing houses and what's happening when it comes to canceling of trades. And I think that's absurd. Everyone should be responsible for the risk that they are taking. But obviously, this is I think it's very normal to see the amount of also producers in commodity producers hedging to the level or to the degree that we're seeing. And this is a very classic sign of being in the beginning of a bull market. So companies have been very forced to be conservative and hedge the underlying commodity price of whatever they are producing. And so the covering of those hedges may actually cause some short squeezes in some markets. And so I think those are the important points to be watching for in this market.
Now, Russian President Vladimir Putin has instructed the Central Bank of Russia and the Russian government to come up with a report by the end of March on how to change the payment for Russian gas to rubles for customers who are part of Putin's so-called unfriendly countries list. However, European countries, which pay mostly in euros, have so far rejected the demand, with Germany and Poland calling it a breach of contract. What is your read on how this could all play out?
My read of how this all plays out, I don't think necessarily it's the end of the dollar being the reserve currency or any more extreme thought about the development of those stories. I do think that this all goes back to the short thesis on the treasury market, because clearly we're seeing that treasury markets are not as liquid as a form of reserve as most thought, and that's number one. Number two is we went through from the 70s thinking about just the break of the gold standard to now, and what it means to have a very high quality or credible central bank with a credible fiat currency. Since the 70s, those central banks have been the ones that actually own a lot of US treasuries. And that just means owning a lot of debt from a historically indebted economy. And I'm not sure if that's going to be the case going forward. And I think gold is going to play a role into improving the international reserves of countries in order to create some sort of anchor to their fiat currency. So this is an important story for precious metals, in my opinion. But it's I think it's still very obscure to have a view about what's going to happen when it comes to the dollar developments. I don't think that this is really going to change in a large way as other people are thinking when it comes to the end of the dollar as a global reserve currency. I don't think that's really where this is going to go. But yeah, I'm more concerned about that shift out of treasuries that I think could potentially cause nominal yields in the U.S. to rise. And I've been saying that that's a risk, and I continue to believe that, especially with the Federal Reserve now today exiting the QE, which has been one of the biggest of institutions buying treasuries on top of U.S. banks, will become more challenging to continue to suppress rates in the nominal terms here in the U.S. And that's going to become a story, I think, in the next months of how to suppress rates again in the nominal terms again.
Yeah, the US is sitting with negative real interest rates and parts of the yield curve are inverting. How do you think the Fed will try to maneuver given the circumstances?
That's very challenging. This is like middle part of 2019 when we've had a list of recession indicators, flashing warning signals. Yield curve inversions is certainly one of them. This is not like '08. This is not like 2020. This is not like 2000. And I mean that because if you do a research on what's happening in a yield curve, so right now we have about 20% of the treasury curve inverted, meaning there are about 45 or 46 possible spreads in the yield curve. 20% of them are basically inverted. This changes every minute, but it's about 20%. And so when we reach about 60%, that's when every time in history we've seen a recession follow. We're now seeing the 2 versus 10s very close to an inversion. There are other yields that are very close to inversion as well. So we may see a jump towards 40% very quickly from here. I think that's concerning. We're also seeing the Federal Reserve tightening late in the cycle, which I think it's also a problem. Consumer confidence, I put a chart out the other day, which has an uncanny relationship with predicting recessions and downturns in the economy of the expectation or the present situation of consumer confidence relative to expectations have been spiking, meaning consumer confidence is falling on the expectations versus present situation. And those are all big deals. Those are all recession indicators that are, again, flashing warning signals. And I think what we're going to see, however, is that yields are actually going to continue to rise. The Fed is 100% focused on restoring their credibility regarding inflation. And I think what's going to happen is we may see a very, very similar scenario that we saw back in 1973, 74, with the Federal Reserve being forced to go after inflation at the same time as the monetary tightening caused by that and the deceleration of growth and downturn in growth created a recession. So I think we're headed towards that.
So last year, you presented various ideas about how 10-year yields would be at 2.5% to 3%. We're now near 2.4% as we speak. Where do you think things could go from here?
Well, thanks again for letting me have a victory lap on that one. But I think last time when I said this, I thought if we reach the 2.5% and 3%, I'll probably be out of that trade. And I've been changing my mind about this because I haven't heard a word from any Fed members or policymakers regarding their concerns when it comes to nominal rates rising on the long end of the curve. And I think first we need to see those concerns come up before we start being more worried about covering that Treasury short. I believe strongly we're going to see the Treasury market continue to sell off. QE is ending today. And we've had this geopolitical tensions are certainly going to add to the table when it comes to the potential demand for the instrument. And I think this is happening worldwide, meaning I think developed economies are facing the same problem of interest rates rising on the long end in particular. And that has a lot to do with the issuances of those instruments. In the US, just happens to be the case that we have all the data and the clarity to make all the analytical work to have a stronger view. And so I am seeing somewhere close to $850 billion of treasuries being issued in the last 3 months, and that's absurd. I mean, we're not in a recession, we're not in a pandemic program, stimulative packages. We're not seeing any. We're not in a war right now. I mean, this is 3 months from February, if you think about it. This is even before or right at the very beginning of the Ukraine and Russia invasion. So when you start thinking about what's the reason behind this insane issuances of treasuries, I don't think that's going to end anytime soon. And so who is going to be the buyer of this going forward? Ultimately, this will become a narrative. What has surprised me so far is that has not become a narrative. And it's not in most people's radar. And when you look at the 10-year yield, it's been in this downward channel for a while, all the way back to the 80s. And I think we're going to break out of that. I think we're just taking a breath right now. And it's going to become the new narrative. It's going to break out. It's going to scare a lot of people. It's going to spook the markets, in my view, and that especially long duration technology companies being one of them. And I just don't think treasury yields should be at even 2.5. I think we're going to see. I think now we're going to see 3 to 3.5%. And again, this is adjustable. When we hear a Fed member speak out about this, I'm going to change my view and I'm going to start adjusting that target. So, but continue to be short treasuries.
Mm-hmm. Okay. So one more thing before we let you go here. Are there any sectors or metrics you're closely monitoring that you'd like to share?
Well, I'm again closely monitoring the margins of companies' fundamentals, because they continue to be at peak levels still, and we're seeing a lot of leading indicators, perhaps telling us that the margins are going to get squeezed by energy prices, by wages and salaries, by material costs that are rising. And I think those are all stories that are still yet to develop. And when we see that happening, I think we're going to see this. When the peak earnings story starts getting out there, we're going to see the kind of the lower confidence by CEOs and corporate management in general in the US. And that is when the economy starts to really turn. And yield curve inversions is an important part of that. It's hard for companies to really start investing a lot of money when they see things like that, things like the yield curve is starting to invert. I think that spooks a lot of those decisions. So I am paying close attention to fundamentals of companies, because I think they're going to turn lower, not higher.
Okay. Well, thank you so much for coming on today and sharing your thoughts with us, Tavi. It's been so nice to talk to you again.
My pleasure. Thanks for having me.
To our viewers at home, thank you so much for watching today. We'll be back again tomorrow, and you won't want to miss what our guest has to say. So be sure to stay tuned by hitting that notification bell before you go.